Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today we're going to go through the Primary Vision Frac Spread Count. So instead of doing it on Friday, we're going to pull it forward and do it today, Wednesday, before Thanksgiving. So you have something to talk about with your family, obviously, because who doesn't want to talk about this during Thanksgiving dinner? But some of the key pieces that we rely on to go through the algorithm, make sure that it's right, came out today with the rig counts coming out finally. So that's why we pulled this forward, so you have the information heading into hopefully what is for you a long weekend. So before we get in, please like, share, subscribe. Your support is appreciated, and look out for next week. We're going to do a deeper dive into what is fracking, why is fracking not dangerous, why it is something that is to be considered and to be appreciated, obviously with the proper oversight, with the proper restrictions, just because we can't do things blindly. There needs to be some oversight, but why there is a benefit to fracking in the long term. And this is something that you can use to prove your point right on why energy is important after your Thanksgiving battles. But without further ado, the Primary Vision Frac Spread Count for today is 135. So that's an increase of 8. So we went from 127 to 135. And it's important to understand, okay, well, what does this mean going forward? What happens now that we have Thanksgiving? So this will walk back a little bit. But as we've been talking about, a lot of the support is going to come in key areas. So some of the key areas is obviously the Permian. So the Permian went up by 3. It's something where if you got our report, read the report, and what we've been saying the last couple of weeks, we expected another, let's call it 3 to 5 into the end of September, into the end of November, and here we are with another 3 addition. The interesting one is Denver. So Denver had another increase. And when you think about, okay, well, why Denver? That seems odd given where some of the numbers are, where some of the spreads are, because they're really not all that strong. It comes down to managing decline curves. And that's what we keep talking about, because you need to manage your decline curve into year end, show, protect it as you head into exit rates, and then really start to set yourself up for not only Q1, but also Q2 of 2021. For the most part, everything else has stayed fairly firm. Anadarko, Appalachia, Texas, Louisiana, Mississippi Salt. You went to Western Gulf. Western Gulf had a little bit of an increase. And again, as we go forward and as we head into the remainder of the year, we expect to see a lot of activity continue to be supported in the Permian and in the Eagle Ford and just in Texas in general. Appalachia, Haynesville is going to stay fairly flat over the remainder of the year. Appalachia typically has a little bit of a decline as it gets colder, so we would expect to see another 2 to 3 spreads come off in December. But again, that's clearly along the seasonal norm. It's just obviously we're starting from different levels. The Permian is the one that is going to get the most love. And when we look at just where is the rig count, so rig counts went up in the Permian, rig counts went up in Western Gulf, and they've been fairly stable pretty much everywhere else. So when we look at where do we expect to see the most activity, it's going to remain in the Permian. The Williston, the Bakken in general, has been fairly flat. We think it's going to remain between, let's call it, 8 to 11 in terms of just where we think frac spread activity is going to be, and we're right within that sweet spot. Again, the Permian is going to be the driver. Now, as we look at this, the last 3 months, we can get excited to say that this is the highest it's been in a 3-month period. So, yay, we're some sort of normalcy back into the oil patch. But when you look at, okay, well, crude prices have obviously gone up. That's helping some guys go through and do a little bit more. Next week, we're going to look more at hedging and, okay, well, what is the hedge profile of E&Ps heading into Q4? What does it look like going into Q1 and Q2 of 2021? Because we're seeing pretty fairly hedged going into the end of the year, and then hedges drop off pretty aggressively through Q1, Q2, which is going to be an overhang for earnings, as well as just what the pace of activity will look like. So we're seeing a lot of that pull through. Again, we remain within this 127, 135 range. There's not too much to say it's going to go up. We think we'll probably lose, let's call it, 2 or 3 spreads into next week, and then that'll come back, and then we'll stay within that pretty much that confidence range as we go through the remainder of the year. Now, the reason why you can see that the pace of expansion has been fairly stable, the trend has been up, and now we think it's been up, and now it's going to start to go sideways. You can see in 2019, and if we put other years in this chart as well, you would see the same type of drop-off that we normally get, call it the week before Thanksgiving, the week before Christmas into the new year. And there's nothing to say that we're going to see anything like that right now, just because we're already at such low levels. We're already trying to manage cost as much as possible. So we'll see some drop off, but again, it won't be the same type of big move where we saw going from about, let's call it 350 down to 300. We're not going to see the same type of 50 spread drop off. So we think it's going to be fairly stable overall. And we're just going to see this activity. The question is going to be, what is the exit rate? As we continue to see these spreads come back, this activity come back, not only in just the fringe areas, but also in some of the more core areas, that's going to help support some of this oil production and natural gas and other production, but really oil production into year end, where we were expecting to be at about 10.5 to 10.7. Given the level of activity that has continued to persist in the market, this is going to push us much closer to that 10.7 million barrels a day into the exit of the year. So that's all we have for today. Please watch the EIA show. We kind of tie in a lot of the international and what we expect for the demand numbers and what we expect to see going forward, specifically in terms of storage and in oil and refined products, as well as not just in the U.S., but also abroad, because we think that there's going to remain some headwinds as we look at oil exports into the end of the year, just given the oversupply in Europe and just where some of those issues are going to remain into year end, and then actually well into at least January and into February of next year. So thanks again for watching. We said it in the EIA show, but just to say it again, we hope that you have a great Thanksgiving, spending time with family. Hopefully you're able to see your family, or if it's a little bit smaller because of COVID, just remember next year it'll get better, or at least we hope so, and we think so. So thanks again for watching. If we don't talk to you beforehand, have a great weekend as well, and enjoy time with the family. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.